Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing from Carter's Inc. Don't let the name fool you, we're not talking about baby clothes, well, mostly not. This report is about how they're doing as a business and whether they're making money or losing it. Let's see if they're sewing up success or if their financial scenes are coming apart. This is a report called an ATK, which is basically a quick update they have to give to investors about important events. This one is all about their financial results for the first quarter of 2025 that ended in March. Companies use these forms to keep everyone in the loop about big changes or important news. For Carter's, it's their quarterly financial performance that's important enough to share right away. The main point of this report is the announcement of how much money Carter's made or lost during the first 3 months of 2025. This is where we find out if the company is healthy, growing, or struggling. It's like taking the company's temperature to see if it has a fever or a clean bill of health. Here we can see that the press release from April 25, 2025 contains all the details. The numbers and all that good stuff is inside that press release. Now let's try to find that press release. Unfortunately, the report itself does not include the financial details. We need to look at Exhibit 99.1. Let's imagine we got access to it and focus on a few key numbers to understand how Carter's is really doing. First, let's look at their net sales. Imagine they announced that net sales were down 5% compared to the same period last year. That would tell us they sold less stuff. Not good, but let's put it in perspective. A 5% drop isn't a total disaster, but it's a warning sign. It could mean people are buying less clothing due to the economy, or that Carter's is losing ground to competitors. Next, let's consider their earnings per share, or EPS. Let's pretend they announced an EPS of $1.50. Now, is that good or bad? To know, we need to compare it to last year and to what analysts were expecting. If last year's EPS was 120.75 cents, that's a drop of about 14%. That tells us they're making less profit per share. Maybe their costs went up or they had to lower prices to compete. If analysts were expecting, if last year EPN dollars were expecting, if last year's EPS was $1.75 in consensus, they're making less profit per share. Maybe their costs went up or they had to lower prices to compete. If analysts were expecting their spent, that tells us they're making less profit per share. Maybe their costs went up or they had to lower prices to compete if analysts were expecting sins, which could upset investors. Finally, let's check out their inventory levels. Suppose their inventory is up 10%. This could be good or bad. If sales are expected to increase, more inventory is good. But if sales are down, having too much inventory could lead to price cuts just to get rid of it, which reduces profit. The rest of the report is mostly legal stuff. Now let's talk about Carter's as a company. Based on this report and assuming a downturn, we can guess at their strengths and weaknesses. A big strength might be their brand. Carter's is well known for clothing, especially for babies and kids. This recognition can help them keep customers even when times are tough. Also, they likely have a good handle on their supply chain. The ability to efficiently get their products from factories to stores is super important for keeping costs down and making sure products are available. On the flip side, a weakness could be their dependence on retail stores. With more people buying online, having a lot of physical stores can be expensive, especially if those stores aren't making as much money as they used to. Also, the children's clothing market is very competitive. They have to compete with other major brands, smaller boutiques, and even big retailers that sell their own store brands. Looking ahead, there are definitely risks. The economy is always a big one. If people have less money to spend, they might cut back on buying new clothes for their kids. Also, changes in fashion trends can be a risk. If Carter's doesn't keep up with what parents and kids want to wear, they could lose sales. But there are also opportunities. They could grow their online business. With more people shopping online, improving their website and online marketing could bring in a lot more sales. They could also expand to new markets. Selling their products in other countries could open up new sources of revenue. In conclusion, Carter's is a well-established company with a strong brand, but they need to stay smart about adapting to changes in the market. They need to manage their costs, keep up with fashion trends, and find new ways to grow their business. If they can do that, they should be able to keep those financial seams from coming apart. Thanks for watching. If you enjoyed this breakdown, hit that like button, drop a comment, and subscribe for more corporate deep dives.